You're doing everything right. You save money. You invest. You avoid debt. And yet your mortgage is still expensive. Stocks feel unstable. And money just feels tight. Now here's the scary part. What if the problem isn't your bank? Isn't your government? Isn't even your economy? But a country thousands of miles away? Quietly pulling the strings? And almost nobody is talking about it. Every time the market drops, people blame something loud. AI bubble. China. Elections. Interest rates. But those are distractions. Because the real force behind global markets is boring. So boring that most people scroll past it. Government bonds. Not crypto. Not stocks. Not tech. Just bonds. And hidden inside that boring market is a ticking shift that could affect your rent, your investments, your future wealth, and it all starts in one place, Japan. Rewind to the 1990s. Japan was unstoppable. Real estate was exploding. Stocks were booming. People believed Japan would own the future. Then suddenly, everything collapsed. Prices crashed. Markets crashed. Growth disappeared. And Japan entered something now called the lost decades. For nearly 30 years. Nothing moved. No growth. No inflation. No wage increases. It was like the economy hit pause. And nobody could press play. So Japan did something radical. They dropped interest rates to zero, then below zero. And when that wasn't enough, they did something even crazier. They controlled the entire bond market. They said, we don't care what the market wants, interest rates stay low. This was called yield curve control. But here's what that really means. Japan made money, almost free. Now imagine you're an investor in Japan. You have billions to invest. But your government bonds pay 0%. So you have two choices, earn nothing or go somewhere else. They chose option 2. And this is where everything changes. Meet Alex. Alex borrows money in Japan at nearly 0% interest. Then converts it into dollars and buys US assets earning 4% or more. He keeps the difference. This is called the yen carry trade. And it became one of the biggest money hacks in history. But here's where it gets crazy. This wasn't just Alex. This was banks, hedge funds, pension funds, all doing the same thing. At massive scale. Trillions of dollars. This flood of cheap money didn't just buy bonds. It bought everything. Stocks. Real estate. Tech companies. Startups. If it made money, it got funded. This is why markets kept rising. Because behind the scenes, Japan was quietly funding the world. They became the world's ATM. But this entire system depended on one thing, that Japanese interest rates would stay low forever. And for decades, they did. Until suddenly, they didn't. In 2024, Japan changed direction. They raised interest rates. For the first time in years. Then they raised them again. And instantly, markets reacted. Stocks dropped. Volatility spiked. Fear returned. Because the free money was no longer free. Now think about what happens next. If borrowing in Japan becomes expensive, the entire trade breaks. Investors stop borrowing. They start selling assets and even worse. They bring money back to Japan. This is called repatriation and it's dangerous. Because money isn't just leaving, it's reversing. Now here's the part nobody explains. For decades, Japan was one of the biggest buyers of US debt. They helped keep interest rates low. But if they stop buying or start selling, then something has to adjust. Interest rates rise. And when long-term rates rise, everything changes. Stocks become less valuable. Housing becomes less affordable. Businesses struggle to borrow, because long-term interest rates control the price of money, not the headlines, not social media, not hype, money. Here's the biggest misconception. People think, if the Federal Reserve cuts rates, everything gets easier. Not true. Because the Fed controls short-term rates. But long-term rates? That's supply and demand. And if demand weakens, rates stay high. Even if the Fed cuts. That's why mortgage rates stay elevated. Markets feel unstable. Money feels tight. Even when policy says it shouldn't. The real risk isn't a crash. It's something slower. More subtle. More dangerous. A world where money is no longer cheap. Liquidity disappears. Growth slows quietly. Because for 30 years, the system relied on one hidden engine, cheap Japanese money. And now, that engine is turning off. The biggest risks in the world are never the loud ones. They're the quiet ones. The ones hiding in plain sight. The ones nobody clicks on. So while everyone is watching AI, stocks, headlines, you should be watching liquidity, bonds, capital flows. Because that's where the real story is. If you want to understand what's actually moving money, what's actually shaping markets, and what nobody else is talking about, then this channel is for you. Because here, we don't follow noise. We follow reality. Subscribe to the Visual Finance. Because the next shift is already happening. And most people won't see it coming.